Hey, this is Sasha, and welcome to a quick little option training video lesson. Now, today I want to show you a little strategy as far as vertical spreads are concerned, so that way you can see how to construct one. Of course, keep in mind it's not a recommendation to do this, to buy or sell or trade any stocks or securities in this video. It's just to give you some insight on what you could do when it comes to options. So today we're going to take a look at a bullish and bearish vertical spread as far as buying goes when we look at Apple. So that's what we're going to do, and that's what we'll construct. So let's take a look here on screen. First off, let's look at the chart of Apple. You can see overall, if you want to use technicals to get a little insight and idea of projection directionally of where the stock's going to go, you could say, okay, well, this stock is now potentially above this 165 level. It's going to go a little bit higher and continue in that motion. If you believe that, great. If you think it's a little overextended, well, in that case, you would maybe put on a bearish vertical spread. So we're looking at two different approaches depending on which way your bias is on the direction. These are directional bets, so they're not kind of monthly every month. It's more of looking for a direction. So the way that this is done, and let's first do an upward movement, right? Upward movement on a construction for the upside. And this would be a bullish vertical spread. And the way that it's set up is, let's go ahead and pop in our ticker symbol right here. Go ahead and put in Apple. And as we go into Apple, let's say we want about 60 days until expiration. So give us 60 days. What I'll do is I'll go ahead and do a 180. Let's say we'll buy a single contract here. I'll analyze the trade. And you can see this gives me unlimited upside, right? So now the downside here, of course, is I'm paying $365, $3.65 to open up this spread, to open up this option contract. So what you do in order to reduce that risk is I'll go ahead and sell one at a higher level. So let's say, well, it's going to probably go higher, but I don't think it'll get to 210. And even if it does go to 210, it won't get beyond, let's say, that much further. So I'll sell one over here, and this helps offset the price. So we'll sell a single. It helps offset the price of that that cash, the cash that I have to pay for that initial amount. So let's say normally you'd pay $3.65, right? $3.65. So that's your max loss. But if you add this in, let's say the one that you sell, well, now you're only paying $3.42. So now you still have some good upside room, your potential to make $2,663 on that movement for risking $337. Now, if you believe it won't go as high and you want to bring that in a little bit, sacrifice a little bit of your profits, well, you could bring this in a little bit slightly to, let's say, the 200. And now, instead of paying that 360, you're only paying about 305. And again, if I bring it in even further, let's say to 190 on my vertical spread. So now let me spread this out a little bit so you can see. Now I'm really only paying $234 right here, $234 at expiration to potentially make, of course, it's not $2,000, but it's about $772. So you're almost looking to, I'd say, not quite triple your money, but double your investment or margin amount, because you're bringing in a credit here of $1.26 and you're buying for $3.55. So the difference between those two is what you're left, which is the $228. Now, in this case and scenario, the stock does have to move to about 190 or higher at expiration. Now, if it moves somewhere in between there, let's say 186, well, you still make about $402, right? Because that's expiration. Now, can you get out of this before expiration? Absolutely. The white line is your T+0 line, so you could still get out before expiration. If it goes to 220, well, tomorrow you can still get out of it. If it goes to 250, well, instead of normally, let's say if you bought a single at 250, you would have made, let's say, about $6,000. In this case, since we're selling one right here at the 190, it caps our potential win. But keep in mind, how often is a stock like Apple going to explode to 250 within 60 days, right? You're looking for a massive movement, and the chance and the probabilities of that is slim. So this is kind of looking at a bullish vertical spread. You could go ahead and put this order in similar to just going and doing a single vertical as a single order. And as we analyze that trade, you could do that as well. So let's say 170 and 180, I could play with my strike prices, and I could even get it a little bit closer, but now you're risking a little more, but your chance of success is a little higher because you're right kind of in the middle where the price is, right? So that's kind of the difference. So you're risking 460, 470 to make about 530, 1-to-1 kind of risk to reward ratio. I could go in even, let's say 165 and say 175. So now I'm a little bit more on the inside area where the stock doesn't even have to move, and then you're still profitable $156, but it has to stay above that level. So again, it just depends how you want to play it. Now, the put side is very similar. If you're looking for a bearish move, thinking, hey, this stock is overextended. You know, this move has just went up too far too fast. It's going to pull back. So if you're looking for it to go down in value, you can do the same thing. Well, on the put side, you buy a single. I'm going to choose the 155, 160 area right here. Let's go 160. It's a little bit closer. Has a higher chance of working out. So now you could see there it is. There's my downside move on the stock. But the problem, of course, is, well, I pay $204 for that. So what do? Well, to offset that, I could go ahead and buy or sell one right here, actually. So we bought one and now we sell one. So this caps my potential gain to 1,831, but now I'm only risking 169, right? Without that, I would be risking 204. So this 35-cent credit allows me to take the 204 minus 35 cents. So it allows me to reduce my exposure on the trade. Now I could dial this back in and let's say, okay, we'll cap it at 150. And now I'm only risking about $121 on the trade to potentially make, let's say, 882. And of course, you could play with these numbers. Let's say I bring it back even tighter, let's say 170, and get in to about 165. So now my credit on the differences here is basically I'm risking 175 to potentially make 325. So you could see how I'm playing with this to see what my risk and reward strategy really is on the numbers. So again, I could go 170 and go to 175 right here. And now I'm kind of right in the middle, splitting those strike prices. It allows basically that stock, as long as it just keeps going down, I'm good. And this white line is that T+0 line, which means I could go ahead and make money tomorrow if it starts dropping. And with time, as basically time moves forward, that white line will continue to get closer and closer and closer to the green line. So with time, I'm actually, if I get into 160 and it stays there, that white line, I could just let it sit and I could even let it expire if I wanted to. I could do the same thing, let it expire on the call side as well. But you can see how this really works is that it gets closer and closer. And this is the way the bullish and the bearish vertical spread works. Can you put this in as a single individual order? Absolutely, I could go ahead and buy a vertical here as well, analyze the trade, and now you can see how it works. Let's reset the time. And there you go. So you could see right there risking 108 to make 392. If you want to risk less and go wider and think, hey, it's going to totally blow up and go down, well, I could go really far out right over here. Let's say, I don't even know the strike prices. Let's see where 145 and 140. So here we go. So now I'm risking only $17 to be able to make on this trade 483. So on a percentage basis, think about how big that is, right? I'm only risking $17, but this stock needs to pretty much crash, go to 10, 20, 30, about 40 points, call it 35 points for me to be able to make money. So 35 points from here would put it, let's zoom out a little bit, 35 points from here would put it basically a 20% sell-off. So you're talking major bear territory, right? So here we only had 20, 30 points, and that was calling it at the top. Imagine if we're not at the top and we need to go up a little bit. So that's why the chance of this trade working out in your favor is kind of slim, and that's why it doesn't cost you as much, because the chance of it working is slim. but you make a huge reward if it does work out. Whereas if you bring it back in, let's say 165 and 155, you're putting up more on capital, right? 173 to be able to make 827, but the chance of it working out is higher, chance of it working out in your favor, simply because you're closer to where the price currently is. So anyways, I hope this makes sense as far as trading and setting up a vertical spread when it comes to Apple. You could, of course, do it on, if you're looking for an upside movement, it might be great to do these when the stock sold off 3 or 4 days, because then you'll get a bounce. And the same thing, or on the reverse, into strength, when the stock has been moving up, let's say 5-10 days, well, to set it up for the bearish or the downside. So again, it's just a matter of your strategy and how you look to set up your position and your trade. Anyways, thank you so much for joining me in this video. Don't forget to hit the subscribe button here on YouTube, right here, the circle. If you're interested to get connected with me on my newsletter list and join our family, then go ahead, click this button over here on the side, sign up, and that's where you get some news and announcements of all the great training and products that I have coming out, including the one that we just recently released, the Passive Dividend Investing course, which you can learn more about by getting on the newsletter list and getting those announcements, or checking the description under this video. Anyways, thanks for joining me in this lesson. Hope to see you in my next video.